Good afternoon. Thanks a lot for the excellent lunch. It's not easy to go on now. Ladies and gentlemen, the world out there is a complex. To put it simply, I would say boiling pot. And everyone expects central bankers to turn down the heat. But it was never really our job. And yet the expectations keep stretching. People want us to be unshakable. They want us to supply resilience, even when that stretches well beyond the limits of our mandate. Some have called this being the only game in town. We meet today after successive global turbulences elevated resilience from a supporting element to the very core policy making. The ambition to be never surprised in a world of recurring shocks reveals just now how demanding this role has become. Recent episodes of stress remind us as a key lesson that instability often originates not at the margins, but at the core of the financial system, especially when conditions appear strongest. That all this reshapes how we think about policy. In Europe, this is particularly relevant. Deeper, more integrated capital markets, together with a liquid, common European safe asset, can strengthen both. And this is why the question of the European safe asset has become the part of ECB agenda too. And few scholars have shaped this thinking more than our keynote speaker today. His work has shown that risk is endogenous, that fragility builds in good times, and that resilience must be designed into the system. Today, he's once again at the very top of his game, decoding how and why artificial intelligence is fundamentally rewriting the rules of the global economy. Ladies and gentlemen, Professor Markus Brunnermeier. Please, Markus.
Thanks a lot. I will talk today about the AI transformation, its implications for money and policy, and I will promise you will end up with resilience at the end. So what I want to say today is a few thoughts about what are 5 possible AI forces that drive the change. What are the implications then for finance, for digital money? I will then move on to the big AI bet and innovation bubbles more generally in history, and then talk about repricing risks, sovereign debt crisis, and safe asset status before I end up then with international and AI resilience and conclusion. So I would like to start with the first force. And before I do this, I think what's very important is this delegation aspect and the alignment challenge we are facing. So if you look at the software generations, we had the first generation, a classical coding, which was written by humans and executed by machines on a logical structure. So it's very logical. You knew exactly what's going on, step by step, but you can't deal with unexpected events. No, the machines were not able to do that. Software 2.0 was more like weights fitting the data. So you have all these weights. It's a programmer-specific architecture, a function emerges, and it's partially inspectable or explainable. But what we have now is LLMs programmed in English rather than in code, and it's all about outputs and verifying the outputs and very much black boxy. And you can view this as a principal-agent problem, where the principal is instructing the AI agent to do some things, but it's not just under asymmetric information as in a traditional principal-agent problem, but also asymmetric understanding. So we don't fully understand the full model. It's not just we don't understand the information the agent might have, but the full model is not fully understood. And there's the saying, you can outsource your thinking, you cannot outsource your understanding. So you can give the LLM to say, oh, do this, think this through for me, but you still have to understand it. And this, of course, leads to a delegation problem and alignment challenge. And that's one of the first forces. I want to start with some 5 more abstract forces and then show you the implications. The second force is related, is about speed. So the speed forces more delegation and also leads to a loss of control. So AI will analyze and execute tasks at an inhumane speed, very, very fast. And that forces us humans to outsource and delegate things to AI agents. So in particular, if there's a lot of competition, others outsource it to an AI agent. I have to outsource it as well, because otherwise it cannot survive in this competitive world. And this makes, the decisions and the recommendations provided by them to verify, this makes the verification very unpractical. And we mostly go for YOLO mode. That stands for you live only once. And so we essentially will outsource more and more and let the AI agents decide. And so we lose control. So even though we have formal authority using Aguillon and Tirol's language, we still have the legal accountability, but the real authority is moved on to AI agents. So the effective control over the decisions is moved on. So that's, again, delegation, because the speed will force us on us. The third force is the span of control. So the one classic example is that, I can manage X people, and the manager next down can manage another X people, and so forth. You have a certain span of control. You need deep hierarchies to manage that. In the future, the CEO can manage many more. So one classic example is Mark Zuckerberg is instructed to establish a CEO avatar. So now every employee of Meta can contact Mark Zuckerberg or his avatar and ask what he would think. You can think that some lower-ranked manager can always ask Mark Zuckerberg directly and will tell his direct superior, but Mark Zuckerberg said I should do this and this, or at least the arbiter said this. So this will lead to a very, very different hierarchical structure in many organizations. And it will also lead to a much more concentration of power at the top, because your span of control is much wider. It also means there will be a hollowing out of the pipeline, so there will be no middle managers. We don't need these middle managers anymore, but the middle managers, some of them will be the future CEOs, and so it will be the pipeline, the training pipeline will dry up. And that's another force which will happen. And finally, I think there's a fourth is personalization. So AI enables us to be hyper-personalized. Goods and services will be per user, per context, per moment. So, for example, in education, it will be Socratic AI tutors, very fine-tuned at a particular student. You have some personalized medication, robo-advising, and so forth. What it means also, you have very much the pricing will be very specific. It will be per user, per context, per moment. This pricing which was not feasible before. So price discrimination will be way more fine-tuned compared to earlier. That raises, of course, for central banks a question, how would you aggregate such very, very heterogeneous price information in a meaningful way? And how does this affect if we fine-tune prices all the time anyway for each customer separately, depending whether it's in the morning or in the evening, whatever? How will it affect also the price stickiness? And then, of course, how will this translate through it? And finally, we have seen already what I call the moat rupture risk. A moat is this Warren Buffett story that, a company builds a moat in order to make some profits. And so generative AI erodes the switching costs, essentially from one company to the next company. So the incumbent moat will be weakened. So as you erode these moats, the profit opportunities are also eroded. So it might erode many of profit possibilities for many firms. It destroys these moats. That's for this, particularly we have seen it already for the SaaS companies, the software companies, the so-called SaaS collapse. And but it can also happen for the foundation models, LLM foundation models, like what we have seen with DeepSeek when they came out. So what happens is, of course, that firms will face much more idiosyncratic risk because their mode might be disrupted. And this disruption risk is more idiosyncratic risk it's a form of enhanced idiosyncratic risk. And that, of course, will ask for more, share, more holding of safe assets. And this also might imply then a change in R star. So these are 5 AI forces that drive some change. There are, of course, more, but I just wanted to emphasize these 5. And then I would like to apply them and see, okay, how will then they translate essentially the finance we're doing on digital money? How will it transform the finance we're seeing, given these forces in the background of our heads? Now, coming back to this speed, so if we're going for finance in particular, what are the financial implications? There will be asymmetric speed in some people will have very fast execution of financial transactions, others have slower execution. And of course, as I said earlier, related to that, this leads to delegation to AI trading agents or other agents to do financial transactions or whatever it does. So we have seen this already in algo trading, in high-frequency algo trading, but this will be much more broadly applicable throughout the whole financial industry in credit decisions, payment routings, portfolio rebalancing, treasury operations, and many, many things will be driven by much higher speed, and you will be forced to go with the AI agents in order to keep up the speed of the competitors. And so that's essentially will also mean that central banks have to, if there will be emergency interventions, that might be mostly driven by, on the other side, by algo trades and some AI agents, and the central banks have to prepare for such a world. So that's about the speed. The other thing is, of course, with new LLMs and with this new AI, we will have a different information gap. We always have informed traders and less informed traders. There will be some traders who get way more information through LLMs than other traders. And we don't know whether the information gap between informed and uninformed will be more pronounced or less pronounced. But typically, as an information, I would suggest would actually lead to a bigger gap. In particular, if some traders have the ability to pay a lot of the fixed cost for this information acquisition, and have hence a larger information gap. So there will be, in general, very few investors who invest themselves because they cannot carry this huge information acquisition costs, and there might be more delegated investment, so less retail investment and so forth. And that, of course, has also implications on market liquidity and so forth because we have more asymmetric information in various marketplaces. What we also will have, instead of having ETFs, we have now some leveraged ETFs, but most of these ETFs are static ETFs. We will have, instead of the ETFs, probably way more AI-managed strategies. So much more active funds, but rather than be managed purely by a human, there might be AI-managed strategies. So there will be a continuous model-driven optimization going on. And then the question is, what reputation does such an AI strategy have? So AI's strategies have to build up a reputation on their own in order to attract more funds and so forth. But it will be much more black boxy compared to humans, which you can regulate. So there might be also dangers. Others might just rely a lot on robo-advising. So some AI recommender system, what stocks to buy and how to execute it. And there might be even front running. Given that everything is a black box, if I offer an LLM which gives some stock advising and tells you to buy this stock or the other stock, I might know a millisecond earlier that I will give this advice down the road. And the institution which offers this LLM advising can front run the retail investors to a much larger extent. And given that everything is a black box, it's much harder to regulate these things. There might be even rating agencies which then rate other AI recommender systems. And then, of course, there's a common mode failure. A lot of these AIs might be similar in many natures, and that is, of course, leads to more systematic and systemic risk. And this apparent diversification you think you have, you don't have it because there's much more correlation in the underlying structure as we thought. So what does this mean for financial regulation? So given the black box, regulation is harder, so you probably have to go more for a governance structure. We can, like what we try to do with algo trading, there's a huge debate. We don't have it yet to have the speed regulation. Should we regulate speed that you can only do things, once every 10 minutes or so forth, such as some speed bumps in the transactions, but also in credit extensions and so forth. And are there any workable disclosure regimes for model-driven products where the AI is driving the model, but we don't fully understand what the AI is doing because it's all a black box, even for the institution which offers this black box. And what are the easy or not? Is there a way to regulate this front running if it's driven by somebody who offers some robo-advising and so forth? And how to manage some AI ratings if they rate some other AI funds and so forth, and how to deal with that. And of course, AI will also impact cyber risk regulation and be part of the bank supervision. So these are the things I would say are mostly for the financial sector. Some challenges, of course, this is just a small glimpse in some way to think about this. There are many, many more. I just thought I'd put some of these thoughts together. Now, of course, if everything happens very fast and there's a high speed on all the transactions, we also need money which can be handled at the high speed as well. So we need tokenized digital money in order to satisfy the high speed. Slow money probably will be driven out. Who needs slow money in this world? Everything has to be millisecond driven. Of course, everything what I say is highly speculative. And then the question is, what is more high speed? Will be private money? Will it be stable coins or tokenized deposits? Or will it be public money? Will we have a CBDC with very fast payment systems? And what's the role of CBDC more generally? Is it just a catalyst to improve private money? Sometimes you can think of private money is the way to go, but there are a lot of frictions in private money, which gives the issue of private money some extra rent. And you introduce CBDC just to make sure that the frictions are limited and the rent extraction from the private offers of private money, the issue of private money, is limited. And certain design choice dimensions in these monetary settings you have to think about, and when you regulate and set up the private money combined with a competing public money arrangement. So one is, how much do you want to link the payment system with a credit system? Should the two ledgers be connected or not? How much competition there should be between the different payment systems, the interoperability across the payment systems, and how much do you would like to have privacy guaranteed to the citizens of the country? And so these are the three, I think, key design choices regulators have to face in this setting. And what Jonathan Payne and I developed is essentially there is payment credit privacy trilemma. You can essentially only have two out of the three. Okay, so you can have a perfect credit system where actually you can create additional credit, not collateralized credit, but uncollateralized credit because of this digital arrangement. Or you can have a perfect payment system where there's no rent extraction, so the provider of the perfect payment system is actually not extracting too much rent. Or you can have a perfect privacy, like in cash, privacy like what cash provides, your physical cash. And you can actually typically only have two out of these three. Okay, you can't have all three of them. You have to give up one of them. So for example, and the regulation where you move in this trilemma depends very much how much you choose interoperability. If you choose a lot of interoperability across payment providers, then you get the perfect payment system because rent extraction of a payment provider cannot be too high because there's so much competition. There's no walled gardens in a sense, so the rent extraction is very low. But that hurts credit provisioning because for credit provisioning you need some non-optimal interoperability, so there's a tension there. You can also see if you have a CBDC or some public ledger provider, let's say some central bank digital currency, which relaxes privacy and said, oh, we would like to have some smart CBDC, which also enables some credit ledger going in combination with payment in order to have a joint ledger provided by let's say by a central bank, or then actually it will be the case that actually private ledgers will emerge and compete on, and commercial ledgers will emerge and compete on privacy. So that will be the case that the commercial ledger operator will say, oh, I offer you payments with more privacy, even though it is actually not as good for credit provisioning. And when you think about the linkage between credit and payments, they're typically, if you have competing ledgers, there will be in a competition arrangement that typically will cooperate on the credit ledger. They will have a joint credit ledger and agree on the credit arrangement, but they will have some perfect competition on the payment system and competing on the markups on the payment system. So all of this is a trade-off, or you have to pick 2 out of the 3, or some, there's different strengths you can pick. You don't have to pick 100% 2 out of the 2. You can say 90% perfect credit, 80% perfect payments, and I give up some of the privacy and maintain some of the privacy. So that's essentially the way I see in AI forces, the forces which are driving essentially the finance and the digital money. Now, what I wanted to say next, I want to say about this big AI bet which is undergoing, in particular in the United States, where essentially not only the private sector is betting big on AI, but also the public sector, the governments are betting big on AI. And essentially innovation, so how you finance this innovation, in particular in the United States, you have these foundation models. It's mostly driven by capital markets, where VCs, venture capitalists, and by potentially bubbles. And if there's a failure, it will be mostly borne by equity owners. In China, of course, you also have some AI investments, but it's less the foundation models, more the distilling on the other models, like the DeepSeek approach. But it's not the capital markets, much more depressing consumption, having excess savings, and you invest this excess savings in various industries by state-directed credit. Okay, and the losses are absorbed by the banking system and by state balance sheets. And Europe, Japan, and India, and so forth, they're somehow focusing more on the diffusion. If the technology yields more returns, the diffusion itself, or the application of the AI, they will benefit from that, but not in the foundation models. And I will come back to that. So if you think about the size of the build-out compared to historical innovations in the United States, how much was invested across, if you look at railroads in the 19th century, was about 2.4% of GDP, highways 1.6%, and so forth, electrification 1.1%. So AI is predicted to be about 2.8%. So that's at a high scale, but it's not extraordinary. And here in this table, I don't have much time to go over this whole thing. So if you look at the different technologies and technology areas, it was always the case, or many times the case, that it was a large fraction of these investments leads to a large valuations in the stock market, and it was always very concentrated in very, very few stocks. And we see this again. So what we're seeing right now is not extraordinary, that it's the top 7 stocks or top 8 stocks carry most of the value of the S&P 500. This was very common across many different innovation cycles, and here I've listed some of them. And of course, I distinguish between .com bubble, Web 1.0, and the platform economy, Web 2.0, and so forth. It's slightly different. What's different? How it's financed. So sometimes it's heavily debt financed, like the railroad boom was heavily debt financed. Of course, the internet.com boom was heavily equity financed, and so forth. So, and of course, for financial stability considerations, it depends a lot how it is financed. So if you go the type of financing for the AI build-out, it was to a large extent financed by cash flows of the hyperscalers. So until last year, it was really financed. The big players were just using their cash flows, like Google and so forth, to buy all this AI equipment and set it up. And of course, there's also the small startups. They're mostly equity financed, primarily with private equity. We will see some IPOs, hopefully, or probably soon, next month. But it's shifting now. So even last year, it was shifting much more to debt financing. So even the hyperscalers, the big companies, could finance it with their own cash flow to a large extent. They're shifted into debt financing. And that, of course, leads to much more financial fragility in a setting due to leverage, maturity mismatch, and margin calls. So now we'll come to how this financing is done. Is it done in a particularly risky thing? And I will come to this in a minute. Of course, there are some new trends as well. One is this circular financing. We said, okay, OpenAI is actually buying for 100 billion NVIDIA chips, and NVIDIA invests 100 billion into OpenAI. They could have immediately said, we call it 200 billion. These numbers you can just make up and just call everything at a higher level. So the circular financing allows you to actually inflate the numbers arbitrarily. And we saw this a little bit in the dot-com boom, but not to such an extent as the circular financing. Of course, we also see a lot of this financing will be done through passive investments of index funding. So if you invest your pension savings into index funds, you will be automatically part of it once these firms go for IPO. They will be immediately part of the S&P 500, and we all will be thrown in at these high values, whatever the numbers they made up earlier. And we will see this coming up very soon. And there might be some illusion there in this setting. Now, what's more worrisome, and that's it's still small, if you look at how the data centers are financed, there's a lot of financing structures going on which are very similar to what we have seen before the global financial crisis. So there's special purpose vehicles, private credit, that's more prominent now, but especially this structured financing is coming up. So CMBS's financing is going on here, just some numbers. That's I've drawn by some talk by Steen van Nieuwenburg. And it's still small, but it's growing very fast. So it's not like subprime, where subprime was at the end also small, but it was larger than what it is for this financing. But you see exactly the arrangements of this finances, debt financing. This is always done with leasing contracts for 4 years and then another 4 years, done in such a way that the rating agencies still give you a AAA rating, and they're playing the same game we have seen, the same movie we have seen before. It's just still at a much smaller scale compared to subprime financing, but we're seeing the same movie coming up again. Now, with this backdrop, let me go to the repricing risk and then say what is the linkage to sovereign debt crisis and safe asset status. So what are the different scenarios and where will the big value creation happen? So one thing is to say, okay, the big value creation will be with the big AI firms, with the foundation model. I call it the foundation model scenario. So there will be 2-3 big tech firms, and they essentially will get all the revenue from this. They can extract the rent for this new technology. And any other software company and any other companies which applies this AI, they will have much lower switching costs, so much more competition going on among the firms which apply that. So the rents will all flow to the top, and anything below the rents will be through competition eroded because the switching costs are much lower. That's one scenario. The other scenario is that we have a commodification of these foundation models. So the foundation models are very similar. You can easily switch from one AI foundation model to another AI foundation model. Some of them might be even open weights, like Meta. And so the rent extraction at the top at the foundation model will be very low. So all these huge investments we have seen will not translate into huge profits down the road. Most of these things have been written off. The rents will be much more among the firms which apply these AI models and can be more efficient at the lower level. And the current stock market, of course, bets tremendously that the foundation model scenario is the one, and that's what the stock markets reflect. But let's suppose, and that's probably what Japan or the Europeans hope, it is the commodification scenario of the foundation models. The second scenario is more prominent. Then we will have a huge repricing coming up on the stock market, and on any claims which are written on them, also the claims, the SPVs and private credit have to be highly revalued. And that, this might be huge dislocations in the financial markets and should be part of some stress scenario testing. Now, this also translates not only for the stock market and the private capital markets, but in a sense, the United States has also made a huge AI bet. The United States has a huge fiscal deficit every year, 6%, 7%, whatever. It's just not sustainable. But it is sustainable if AI makes everything much more productive. So this AI productivity gain scenario is essentially the big benefit. So here, that's a slightly different scenario. It could also be that the application is very productivity enhancing and leads to more tax revenue, and hence the fiscal situation becomes sustainable. But if not, then we are in a bad situation, a bad fiscal situation as well. And then the fiscal debt situation is unsustainable. And from that, you might have the amount of shortfalls, you may have all these stranded assets and the write-downs, and this might not only hit the private sector, but also might hit the official sector, given the high debt level we are facing. It might also undermine the safe asset status of the U.S. Treasury, the exorbitant privilege the U.S. Treasury has from being the global safe asset might be undermined from that. Now, what makes it more complicated for Europe? It could be that the growth, or perhaps Japan applies for the same thing, that the growth rate stays low, and it could be that the interest rate is actually increasing. So let's suppose there's some productivity growth at the global level. The real interest rate is going up at the global level, but the growth rate in Europe stays low and Japan stays low. Then the fiscal situation gets even more challenging because you have to pay high interest on the high debt level, while the growth rate in Europe stays low. And that makes the situation in Europe even more tricky and also potentially lead to a sovereign debt crisis. I'm not saying it has to, but this is a tension. If you don't have the high growth rate, you have the high growth at the global level in the US, pushing up the real interest rate across the globe because of a joint global market, but the growth rate in Europe or in Japan stays low. So of course the hope is for Europe and other countries, the middle power countries, is that the second mover advantage, or it's the rent comes to sectors which apply AI rather than the foundation model providers. And of course, if you have that, there might be political tensions too within the West, saying that there will be this huge investments in the United States and losses, and then Europe will be the gainer, or Japan will be will be the winner, and there might be some geopolitical tensions coming from this. But it's more for the middle powers, a more benign outcome. So I have to check the time. I'm on time? Okay. So if you're putting this in an international context, and I alluded already to international context, I think, so what the question is, so when we look at international context, we talk a lot about tariffs and trade and so forth, but you might say that actually there's different technologies and data flow restrictions and bifurcation of standard technology standards, that itself might also lead to a segmentation of the financial world too. So because we don't have the same technology standards and we restrict essentially the technology world, or fragmented technology world, and that actually leads to segmentation of the finance world, or fragmentation of the finance world. So you have digital currency areas evolving or emerging out of this with different digital areas. And you might also then, in such a world, if the finance world becomes much more fragmented, we might less have a global safe asset. We might have some regional safe asset where each region has its own safe assets and uses this when there's flight to safety, using these regional safe assets to the flight to safety flows, having this. And the big question essentially is that, this is not coming overnight, okay, but it's coming, and there's a transition phase. And how to manage this transition phase. So even if you think this new technology will improve everything and will make our world so much more productive and much more positive down the road, it is typically a transition phase which actually is the more difficult thing to handle. So and you might have temporary setbacks at least, and how to manage these temporary setbacks. In particular, you will have some, as I said, there's this repricing going on, or there might be this moat erosion risk, that you might have stranded assets and so forth. And that's the transition phase is the big challenge. And the other big challenge is, if you have the US and China fragmentation going on, if there's technological fragmentation, where will the middle powers, how will they straddle this fragmentation and this transition phase? And how will global banks, which are currently active in various jurisdictions, how will they straddle it? And the middle powers have to decide, can be part of both, or can they have to decide where to be, and what are the implications then for the global banks. So let me conclude then with this resilience, because it was mentioned in the opening remarks. So what I started out with, I said, okay, here are 5 forces, AI forces, which might reshape finance and money. And then I alluded to AI bet, so essentially the US is betting big time. It's not only the private sector, it's the public sector as well. So to have the fiscal sustainability, you really have this AI bet has to work out. And if not, we will have some repricing and potentially also some sovereign debt risk. Where it will be, I don't know, but it could be in the US, it could be in Europe, or it could be many other places. Now, the transition phase will be the difficult one. So you can have, typically you have a dislocation, some correction, or some setbacks. And it could be a temporary one. If you have the good scenario is a J-curve. First you have a setback, and then you go to in the long run to the good steady state. But as you go down in the setback, you might also hit the tipping point. And because this mode rupture cascades into something, it gets even worse. So you hit this tipping point and might stabilize, like you have in this yellow curve, you might be stabilizing it. Or it might be even darker, that you actually drift off more radically. And might also, if you imagine if you have a big global financial crisis anymore, the trust in institutions will be much less pronounced this time around, or for central banks to be able to intervene compared to the last financial crisis. So it's more challenging going forward. And so the only way to have a resilient outcome is to stay agile and be able to pivot and also maintain the reputational capital of good institutions like central banks. So let me leave it with this. I hope I didn't paint too dark a picture today, but overall I'm hopeful that things will work out, and there's a fascinating new technology coming up we can all work with and increase our productivity. Thank you.
Dear Markus, thank you very much for bringing this issue to this conference. It is very topical, very insightful, even exciting paper. On this popular topic, I would turn to the audience directly without any lingering. So please, first 3 questions, if we do have. Pierre-Olivier, please.
Yes, thank you, and Markus, really a fantastic presentation. I guess 2 questions on the potential risks coming from AI. The first one is you were mentioning the competitive forces, the speed, opacity, and all of this. It was not entirely clear to me why the standard finance portfolio theorems would break down. I mean, at the end of the day, where is the asymmetry that gives an edge to the AI? Would it be eroded by competition? You explained that you could have moat ruptures that would apply also in the finance world. You could look at this and say this is basically pro-competitive effects, and it would lead to a more efficient investment and allocation. The second question is, I think we've all seen in the news in the last 6 weeks, or maybe a bit more than that, one of the big risks coming from AI that you haven't mentioned, so I was a bit surprised by this, is the risk that it could be weaponized to attack the financial system itself. If I think about, anthropic mythos, for instance, and the potential, that's the one that is pretty much under control, and it's on a limited release so that to use it to patch, but what about all the others that we don't know about? And so these seem to be a much more direct threat to the financial architecture and financial stability to me than maybe something about the demand side or the investment boom related to AI. Curious about your views.
Yes, you can.
Very good points. Thanks, Pierre. Okay. Thanks a lot. Very good points, Pierre. So the first point, where does the standard finance theory break down? I agree that if you just have a buy and hold portfolio, probably not so much. If you want to reallocate, in particular if things change radically, you might have to reallocate things. But I think the biggest threat comes from the asymmetry. In a sense, there will be some people who have huge advantage from AI, and others will have smaller advantages in terms of analysis, in terms of information, but also in terms of speed. So all of these things will lead probably to more pronounced asymmetries. And how to handle these asymmetries, it's a little bit before the 1930s. You know, we had also huge asymmetries, and we founded the SEC and all these regulatory ways to handle that. And we have to relearn how to do this new setting in an AI world. And we will probably figure it out, but it will take a while to do that. With respect to mythos and Anthropic's weaponizing financial risk, that's a very good point. So it's probably underemphasized the cyber risk. So the cyber risk is enormous. I don't have much to say except that we have to be ready for that. It shows how important the release policy of new LLMs is, and so that's that's all what I can say. But I totally agree with you; it's a big deal.
Philip, please, then Tao, please.
So one of the important phrases or concepts you had was asymmetric understanding. But there's a pretty big asymmetric understanding between the true believers in the AI world who have these visions where essentially very rapid, very transformational changes. And for people on the outside to work out what of that is true and what is kind of marketing is not so easy. But fundamentally, Markus, I mean, the big issue, and again, maybe from a selfish European point of view, is the balance between the rents going to the foundational model firms versus to those who apply AI in all the different business lines. So I'm going to give you a yes, no. Which of those do you think is more likely?
So I agree first about the asymmetry, the true believers, and whether it's marketing. I must just say in the last 6 months, I'm deeply impressed how much progress was made in these type of models. And that if it continues like this, I think it's just enormous. So perhaps I'm more on the true believer side, but perhaps it's naive. About the rents, I think it's pretty much up to us or up to the regulators to determine where the rents will be. So for example, if you do procurement on the public side, you can say, okay, in order to be part of the LLMs this government is adopting, it has to be a certain degree commodified. So you can enforce a certain commodification of the foundation models. And this way, you know, if I were European, I'm European, but if I were to be a regulator in Europe, I would probably enforce some commodification among the foundation models. And I would also try to protect the application side to some extent. So it's up to the regulators to some extent. Of course, the political interests are very different, and the lobbying power probably of the foundation models is much bigger at this stage. But that's essentially to be decided in the next 12 months or something, how to implement that.
Now Tao and then Claire B.
Thank you. Thank you, Markus. Fascinating talks. My question is related to your remarks on, the speed. Speed is very important, and slow speed money will be driven out by the new money. So based on that, what is the implications to, the central banks, if central banks, the money and, whatever, public money or private money, both, it is not up to speed, then it could be the scenario that central banks could be driven out or become even less less irrelevant. And particularly, the big power play and the implication for the central banks of medium-sized economy, definitely they are, as you said, they are diffusion receivers. So in terms of that, if they are not up to the speed, they become even more irrelevant compared with, the big economies. Thank you.
Yes, a good point. So let me just say my basic philosophy is that essentially if you have CBDC on public money, I think I'm in favor of CBDC arrangements, but it should be more a threat to the private money to be more efficient. I think whenever it counts something, the private money will be probably speedier than the public money. But you need the public money just in case of a cyber attack or something to fall back on public money. So there is too little investment in resilience on the private side, and that's where the public side has to step in and provide the resilience. That's one thing for cyber risk considerations, coming back to Pierre Levy's point. The second thing is the private sector will always try to extract some rents in the setting, and the question is, can a competition from the public sector through a digital money from the public sector erode this rent extraction? And I think that's also a role. So it's essentially just an efficiency enhancer, and it can be an out of equilibrium threat. So just having this sitting there and saying, well, we have this threat, and because of this threat, the private sector is actually not extracting so much rent. Ideally, the public sector should also be as speedy as the private sector. How this will play out, I don't know, but at least as a backup, you need a public sector, in my view. You can't just not have it.
1 minute left. Claire, please.
Okay, that was fantastic, thanks. The question I wanted to ask was less about sort of the end of the world or the transformation of the world, but to bring it back to our sort of day job around the value of money and inflation. I mean, you talked a bit about what this means for prices. I wondered if you could say a bit more, if my agent is only buying things from your agent and they're highly personalized goods, what happens to inflation indices? What happens to people's expectations of inflation? Are we all wasting our time talking about 5-year inflation expectations and all of that if actually goods become hyper-personalized, prices become hyper-personalized? How do we keep any grip on this?
I have to admit, I don't know. But of course, we have to aggregate our much broader range of goods. I think price discrimination will be a big deal. We saw it already in the last few years. There will be more and more price discrimination. That also will lead to some revolt of probably the citizens. I can see the big problems there. How to deal with that and whether central banks should be at the forefront on this is a different question. And to what extent this also will affect, so I alluded to this price stickiness, because you change the prices all the time, whether you have a good mood or bad mood, the price will change, they will recognize it on you. They can change the prices then also for, the price stickiness is less of prominent then. But everything is a little bit speculative what I said. No, I just wanted to stimulate some discussion.
Thank you, Markus. Time is over. AI will be watching you and assess you. Thank you very much.
Thanks a lot.